Banks don't usually appear in battlefield language. They're supposed to be neutral infrastructure, quiet buildings, silent servers, a promise that money moves even when politics doesn't. On March 11, 2026, that separation cracked. News reports described an Iranian military spokesperson saying that economic centers and banks linked to the United States and Israel in the region could be targeted, and warning people to stay away from banks. In one sentence, finance was pulled into the logic of retaliation. In markets, that kind of sentence doesn't land as a headline. It lands as a pricing event. Because this isn't only a story about missiles and geography, it's a story about the plumbing of the global economy, and what happens when that plumbing is treated as part of the battlefield. To understand why a single statement can travel so far, you have to understand what the Gulf has become. Not just an oil region, a switchboard. Over the last few decades, Gulf cities, especially Dubai, turned themselves into places where money, trade, aviation, shipping, and energy all meet. You can run regional headquarters there. You can manage treasury operations there. You can finance shipments. You can settle payments, you can route cargo, you can connect investors in Europe and Asia with projects and businesses across the Middle East and beyond. That's why the Gulf matters even to people who've never been there. A factory in Asia can depend on a shipment whose price depends on freight costs influenced by Gulf risk. A trucking company in Europe can see fuel costs swing because global oil supply is priced on expectations about Gulf stability. A supermarket chain can feel inflation pressure because energy and transport costs creep into everything. And banks sit right in the middle of that chain because banks don't just store money. Banks make the economy liquid enough to function day to day. Most people think a bank's main job is to hold deposits and give loans. That's part of it. But the system that makes global capitalism work is broader and more mechanical than that. Banks provide trade finance so ships can sail and cargo can be paid for. Banks offer short-term credit so businesses can cover payroll while waiting for invoices to be paid. Banks clear payments so salaries, suppliers, and taxes move on time. Banks manage foreign exchange so companies can buy goods priced in other currencies. Banks provide hedging so energy users can plan budgets instead of gambling on daily price swings. When a region becomes a hub for all of those functions, it becomes a concentration point. And concentration points are powerful in stable times. They're also fragile in unstable ones. That's why the Strait of Hormuz always looms in the background of any Gulf crisis. It's narrow, strategically sensitive, and difficult to bypass quickly. When attacks on commercial shipping increase and the area feels less predictable, the first reaction is not a global recession. It's paperwork. It's insurance. It's rerouting. It's delays. It's higher costs. And higher costs are not just annoying. They are contagious. They spread through supply chains like a tax that nobody voted for. If ship operators believe risk is rising, they charge more to operate. If insurers believe risk is rising, they charge more to cover. If lenders believe risk is rising, they charge more to finance the trip. Each more might look small on its own. But global trade is a system of thin margins, tight schedules, and enormous volume. Small changes in cost and timing can become big problems very fast. As tensions rose, oil pushed above $100 a barrel, a line the market treats as a danger zone. Not because the number is magic, but because it changes behavior. Above that level, executives rerun forecasts. Airlines hedge more aggressively. Transport companies raise prices. Central banks worry inflation will stick around. Investors reassess risk. Energy is not an isolated sector. It is the input cost behind almost everything. So even before the banking threat became explicit, the region was already a source of pressure on the world economy. Then came the shift in language. Banks, economic centers, targets. That's the moment the story changes categories. Because targeting banks is different from targeting a military base. It's different from targeting a ship. It's different from targeting an oil installation. Banking is not just a set of buildings. It's a confidence machine. And the most dangerous thing you can do to a confidence machine is not necessarily to destroy it physically. It's to introduce doubt about whether it will keep working tomorrow. In finance, doubt is expensive. It forces backup plans. Backup plans reduce efficiency. Reduced efficiency raises costs. Raised costs tighten conditions. Tighter conditions make crises harder to control. That's the domino effect people don't see until it's already moving. Here's what banks becoming targets can mean in practical terms in a way anyone can understand. Imagine you run a business. You sell goods. You need to pay your suppliers this week. Your customers will pay you next month. That gap between money going out and money coming in is normal. It's how business works. Banks fill that gap with credit lines, short-term loans, and payment services. Now imagine a situation where you hear credible news that banking operations in a key hub might be disrupted by physical threat, by cyber attack, or by security restrictions. What do? You don't wait. You protect yourself. You move cash. You draw down credit early. You delay payments if you can. You hold more money, just in case. One company doing that is normal. Thousands of companies doing that at the same time is a liquidity event. It becomes the financial equivalent of everyone rushing to the exit in a crowded building. Not because the building is definitely burning. Because nobody can afford to be the last one to find out. And when that happens, banks also react. They activate contingency plans. They reduce exposure. They tighten risk limits. They demand more collateral. They reassess which clients are most vulnerable to energy prices, shipping disruption, and regional risk. This isn't about good or bad intentions. It's about balance sheets. A bank's job is to survive. So when uncertainty rises, banks become less generous with credit at exactly the moment the economy needs credit the most. That's how a regional escalation can become a global financial tightening without a single global policy decision. Reports described banks taking precautionary measures across Gulf financial hubs, changing office procedures, shifting work patterns, tightening security. Even if every payment system stays online, that kind of change is itself a signal. A signal that normal assumptions no longer hold. Signals matter in finance because markets are forward-looking. Traders don't wait for confirmed disruption. They price the probability of disruption. If the probability rises, the cost of money rises. And when the cost of money rises, everything that depends on financing feels the pressure. Shipping, construction, trade, investment, hiring. Then there's the cyber dimension, which turns a physical threat into something much bigger. Because in modern banking, most critical functions are digital. Payments are messages. Balances are database entries. Access is controlled by networks. Even cash depends on logistics and systems. Even if you never use a branch, your salary depends on digital rails working every day. Hybrid conflict exploits that. A bank does not need to be destroyed to be destabilized. If payment channels slow down, businesses miss deadlines. If deadlines are missed, penalties follow. If penalties follow, cash buffers shrink. If cash buffers shrink, more people need short-term borrowing. If more people need short-term borrowing, the banking system is asked to do more at the exact moment it is trying to do less. It's a stress test in real time. And the effect doesn't stop in the region. Global banks have exposures that are direct and indirect. Direct exposure is obvious. Offices, staff, operations, clients, loans in the region. Indirect exposure is harder, and it's usually larger. A bank in New York or London might not have huge loans in the Gulf, but it finances companies that buy oil, ship goods, insure cargo, build infrastructure, and rely on stable trade routes. It provides derivatives for hedging fuel costs. It provides credit for inventory. It provides working capital for manufacturers. So even banks far away are connected, not emotionally, mechanically. That's why this story isn't only about the Gulf, and it's not only about the Middle East. It's about how interconnected systems behave under pressure. Because once oil rises and stays high, the economic consequences become predictable. Inflation becomes harder to bring down. If inflation becomes harder to bring down, interest rates can stay higher for longer than businesses hoped. Higher rates don't just affect mortgages, they affect corporate debt, they affect governments, they affect refinancing schedules, they affect investment decisions. If shipping and insurance costs rise alongside higher rates, you get a double hit. Money becomes more expensive, and moving goods becomes more expensive. That combination squeezes margins. It increases defaults. It weakens the credit environment. And it hits confidence again. So when people ask, could this actually break banks? The honest answer is, not in the simple movie sense. A bank doesn't usually collapse because someone said a threatening sentence. But banking systems can become fragile when multiple shocks stack on top of each other, and when trust becomes a variable. The real risk isn't one dramatic event, it's the accumulation. Higher energy prices, higher transport costs, higher insurance costs, operational disruptions, cyber risk, lower confidence, tighter credit, more volatility. Each one pressures the system. Together, they can turn a manageable situation into a systemic one. And that's why March 11, 2026 matters as a decision point. Because the decision wasn't just an operational choice or a tactical warning, it was a shift in what is considered legitimate leverage in modern conflict. For decades, the global economy ran on an assumption that the financial layer, the part where payments clear, where credit circulates, where trade is financed, would remain, if not protected, then at least separate from explicit targeting language. Once banks are named as targets, that separation is weaker. And when that separation is weaker, the world adapts, not with speeches, with architecture. Banks and multinational firms rethink where they place critical operations. They distribute risk across more locations. They invest more in redundancy. They build more contingency routes for payments, communications, data, and staffing. They revise what Safe Hub means in a world where safety includes cyber resilience as much as physical security. Business becomes less about maximizing efficiency and more about surviving uncertainty. That shift has a cost. Redundancy is expensive. Insurance is expensive. Diversification is expensive. And those expenses don't sit neatly in one country. They spread across the global economy as a permanent premium. So the legacy of that March 2026 statement isn't only the immediate tension it created, it's the precedent it reinforced. A new era where wars don't just threaten borders and soldiers, but also airports, ports, cables, data centers, shipping corridors, and the trust that makes a digital economy function. Because once the world starts treating banking as strategic infrastructure in conflict, every major financial center has to ask a new question. Not are we profitable, not even are we compliant, but are we resilient enough to operate when confidence is under attack? And that is the kind of question that changes how global finance is built, where it's located, and how quickly risk can move from a regional crisis to a worldwide tightening without a single bank needing to be physically destroyed. The battlefield, in modern capitalism, can run through the systems that move money, and once that idea is spoken out loud, the world can't unhear it.